Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, November 26, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Before we really get started, we have to backtrack a few days, kind of go over where we've been. There was a little bit of quirky behavior during the Thanksgiving Day holiday week. It's not normal. I want to go over that. We'll talk about it. We'll talk about some important numbers, and then we'll go forward and discuss what I think is going to unfold from here. So we're going to cover everything. We're also going to cover some stocks. We're going to take a look at some charts that may be of interest to various people out there. I'm aware of some things that happened after the bell that can impact a certain stock or two tomorrow. We'll discuss that as well. Before we really get underway, let me first thank everybody for participating, making comments and posts underneath the video each and every night. I appreciate everybody's interaction and participation. It's great for the entire community. In addition, please hit the like button on the video and share the video with anybody that you think can benefit from this information. So let's get into what the action tells us today. Obviously, we had a big, healthy up day. Was there some short covering? Was it a dead cat bounce? Is it for real? What can we derive out of the information that the market is telling us today? That's one of the things, among others, that we're going to uncover throughout this video. First, let's take a look at where we were from the last several days. I think it's important to realize what happened. Even though it's a review, it's important because we can always learn something, and I can almost guarantee you that you're going to learn something from this review of what happened. So a few days earlier, let me move over the chart and then we'll talk about some specific dates. So on the 19th, that was a week ago, that was last Monday, the market had a big down day. We stayed inside the low of the breakup candle. That was okay at the time. What happened the following day? We gapped down. What did we say before that took place? We said our line in the sand is going to be the low of this particular breakup candle, and then if in fact we gap below that or just trade through it, close hourly below that, you know the routine, then our next line in the sand was going to be, and this was our next bogey, was going to be right here. And here's where it gets important. So that low of that breakup candle was our next important line in the sand on the downside. Let's discuss numbers. The low on that candle is 263.12. We're going to go backwards. We're going to go back and forth, so just bear with me. The close here, and this was from Friday, just the other day, was 263.25. I'll show it again. 263.25 on close. Does anybody think that's an accident or a coincidence? Let's go down and take a look real quick at the intraday 10-minute chart and see if we can derive any kind of legitimate information from the activity on Friday. First, we'll take a look at an hourly chart. So we're focused on this area over here at these lows. This is Friday's activity. You can see here that there's actually prints that show up on the chart, but this really wasn't trading activity. For example, the market was closed in the afternoon on Friday. It was a half a day session. Why this shows up on the chart, we'll have to take that up with TradeStation. I'm not sure exactly who we complained to over there about those candlesticks on the chart. But nevertheless, let's focus on the close. So the market closed at 1 o'clock or 1:30. I think it was 1 o'clock. So this candle shows to 1:30. Again, that's an error, but it is what it is. Nevertheless, the market closed above the important number. We're not getting a lot of good data from the intraday chart. I forgot it was half a session, and I forgot that they actually printed the information on the chart. So we're not going to be able to use that. But when we go back to the daily, we can see that it's obvious they closed the day above the low that showed up. If I move this over, above the low that showed up on the 20th. That's important information. That low was 263.15. This low was 263.12. Okay, we closed above both those numbers. Does anybody out there think that that has some relevance? It has to have some relevance. They could have closed it a whole lot lower if they wanted to. So that's item number one. I think it's important information that they were not able to close Well, they could have, but they chose not to close below the low of this break-up candle low. What's our bogey right now on the downside? Same number. Nothing's really changed. We have to use the same exact number of 263.12. That's the bogey. That's the low of this breakup candle. Any close hourly and then daily below that price level, and the market is likely going to go and retest the double bottom and likely go lower. That's not new information. We discussed that at the time. That's basically the line in the sand to lower prices. I'm back to the hourly chart because there is something that I want to show you on the hourly chart. Now, we have to realize that the market's in a downtrend. Let's go back to the daily chart for a second. We have to put everything we do in perspective of what chart I'm discussing and what time frame I'm discussing, because the same things don't necessarily apply on all charts. We have to put in perspective what I'm discussing on what time frame I'm discussing it in. Now, the reason why I wanted to go back to the daily chart is because I wanted to point something out before back to the hourly. Today's close, again, important close, okay? Doesn't mean anything yet, but it can mean something. So the high from the other day on the 21st was 267.15. We closed above that today. It's not an end-all be-all. It doesn't necessarily mean higher prices are coming first thing in the morning, but it is a step in the right direction. Again, that was a choice. The market made a choice to close above that high. It's an important pivot high. It leaves the door open to fill the gap that you see that becomes obvious. That's the next thing I want to discuss. Let's discuss that gap, but let's go down to an hourly chart because I find something interesting. Here, we have to realize that the market is still in a downtrend. It's very obvious. This is a downtrend. There's no two ways about it. But with downtrends come trend lines. Trend lines are either going to be held and push the market lower, or a trend line could potentially be broken and send the market higher. A trend line in this particular case could send the market higher on a bout of short covering, or, as I like to say, panic buying. What if I did that? So the market's in a downtrend, and you can see that we're quite a ways away from that trend line on the hourly chart. We would have to get up to roughly maybe 268 and a half, 268.75, maybe 269. But let me show you, and it all depends on when we get there, right? As you can see, this trend line is sloping down, and so the quicker we get there, the higher price would be when it hits that trend line. But let me point something interesting out. Many of you already see exactly what I'm going to do. Find it interesting that there's a gap to be filled at 269.12. Not that much difference in price from where price may intersect that trend line depending on when and if it does get there. I just think it's interesting, something to note. It would likely be a pretty good resistant area. There would normally be a fair amount, a pretty good amount of overhead resistance around that price area. We'll call it 269 to 269 and a quarter. They'll likely fill a gap. They usually spike through it by a little bit. So in that price zone, you could find overhead resistance. Now, when wouldn't there be overhead resistance? Well, there might not be overhead resistance if, in fact, the market was able to gap above that level tomorrow morning. I'm not saying we will. I don't necessarily expect that it will. However, in plenty of cases, we see the market gap above or gap below certain numbers in order to get through those price levels. Before we wrap up on the S&P 500 or the SPDR, what's the bigger picture? Well, the bigger picture is we're still looking for a significant bottom in this market that we can rally from. Are we out of the woods yet? Not necessarily. We're not out of the woods yet, but this is still, believe it or not, normal and common market behavior. Let me point something out. Let's get rid of this trend line. Let me just point something out. Just take a picture, take a visual picture of what this looks like now. We have a big decline. We have a rally off the decline. We have a retest of the lows or an attempt at a retest of the lows. We don't know if we're done yet or not. Just have that visual in your mind. Now, I've done this a few times already, but keep in mind, this is earlier in 2018. This is January 26, 2018. The market sells off, we rally up, it sells off again, makes an attempt at double bottom, makes a higher low, and takes off from there, and you can see what happened. Now, let's fast forward to where we are now. The market had a pretty good sell-off. We rallied up. We made an attempt at double bottom. We don't know if we're going to make a lower low or a higher low. We're not necessarily out of the woods yet. But as you can see, as we begin to put the puzzle pieces together on the table, the picture generally looks the same over and over and over again. Maybe we get a lower low this time. Maybe we get a higher low like we had last time. Either way, this is the way the market works. Do we have to make higher highs from here? We're not worried about that. We don't have to worry about how high the market might get. We don't have to worry about how high a C leg in an ABC pattern that we may be in might go. Let's worry about if we're in a C leg right now. We're not out of the woods on the downside. We need to see more follow through. This was one day up after a pretty bad week last week. The IWM, as you know, this is my favorite market leading indicator, whether it's on the up or the downside. Again, we seem to have made a higher low. Is that set in stone? No, it's not. The market can easily go back down from here. We're not out of the woods. As you can see, the line in the sand that we really need to clear on the upside is the high of this breakdown candle and the IWM. That high comes in at 152.03. Until and unless we get a daily close above 152.03, this market can still have overhead resistance. This can still be a bearish pattern. Since it's my favorite market leading indicator in either direction, what can we tell from today's activity? We were up a little less than 1% at the end of the day. Is that a good day or a bad day against the S&P 500? Well, the S&P 500 cash index finished up about 1.5%. The S&P or the SPY finished up about 1.2% when you count the activity after 4 p.m. Well, guess what? No, it's not leading the market in the upside just yet. So we have work to do. We have to look at all these markets, we put all the puzzle pieces on the table, and then we come out with either we don't have a clear picture yet, or we do have somewhat of a clear picture yet, or a very clear picture. Right now, we're starting to put the puzzle pieces on the table. We're starting to get the picture put together. We're looking for a rally, but we just don't have the pieces yet. We need follow through. But this is how it happens. This is how the market works. The market's going to jerk you around over and over again while it's trying to find another bottom. Nothing has changed. When we have these corrective moves, we see large swings in both directions, whether it's in the upward direction or the downward direction. Today was a directional swing upward. Looks like everything's fine. We'll know more tomorrow. We need follow through. If we don't get any follow through, the sellers are going to show back up again. By the way, back to the chart of the spider for a second, the daily chart. I'm telling you that this low here at 263.12 is a good line in the sand, and it is. Getting below today's low would obviously be not good for the market. That would be bad for the market. Closing hourly and then certainly daily below today's low is a negative for the market. The transports, my second favorite market leading indicator. So let's talk about the positive side of things on the transports. We discussed the fact that the transports on the chart looked better than all the rest, and the financials as well, but we haven't got there yet. So when we look at the financials, we had that one big washout day last week. That was on the 20th right here. That was on Tuesday, and now we're climbing back up. If you take that day out, what you have in the transports is a bullish pattern. Now, we're not taking that day out. We don't discount activity on a chart. We don't discount price action on a chart. However, this chart does look different than the SPY, the S&P 500. It does look different than a lot of the other charts. It looks more bullish. Why? Because we're making a higher low, but the high is higher than most of the rest. And what I mean by that is, and the same goes for the financials, which we'll get to, when you look at how far this came down, it's a higher low than the S&P 500. It's a higher low than the IWM. It's a higher low than the Qs, of course. We'll get to the Qs. But the transports are trying to tell us that things may not have been as bad as they might have appeared last week. And that's the point I was trying to get across. When we look at the transports and the chart looks different than the S&P 500, we have to take notice of it because it's important information. It's one of the main reasons why, if not the main reason why, I use the transports and the IWM as leading indicators, because when those charts act different, they are canaries in the coal mine many of the time. And by the way, how many times has the transports been a canary in the coal mine for us? They've been a canary in the coal mine for us many, many times. We're going to keep using it because it works. There's a gap slightly above. The transports will want to go fill that gap. If in fact we end up going down and have some kind of market consolidation tomorrow, today's low would be a good line in the sand. Again, hourly closes, and then you certainly don't want to see a daily close below today's low. There is a gap down below. Intraday, that can certainly take place, meaning fill gaps intraday, but we don't want to see a close below today's low. We want to make progress. We don't want to take steps backwards. The tech sector leading the way today. The tech sector, or the Qs, which really isn't representative of the entire tech sector. We know the Qs are top heavy weighted. However, the Qs were up 1.7% today. That's a big number in the Qs. That's a big move. Finish strong, finish near the highs. That's good. We still need follow through. Look how much they've been beaten up. They have been whacked, taken out behind the woodshed, beaten up, shot twice. A lot of damage done. However, a very, very oversold condition, we can have very, very large reflex bounces in the upward direction. Today was one of those moves, up 1.7% in the Qs. Money not necessarily was flowing so much into the Qs. It certainly wasn't flowing out. There was certainly some short covering, but there's also some bargain hunting going on. We'll talk about that when we get to some specific stocks that we'll discuss in a couple of minutes. But the reason why I mentioned about money flowing in, where was the volume? We only had about 41, 42 million shares in the Qs today. The average volume is 62 million shares. If money was really flowing in a big way, fast and furious into the Qs, we would have had at least double the volume. So we didn't see that. We have to take note of it. It's a puzzle piece. It's on the table. We have no choice. The XLF, the financials, looks very similar to the transports. Now that we have the XLF, I want to make mention of something, and I talk about this quite a bit, but I think it's important, which is the reason why I repeat it over and over again. The financials, if the market was going to melt away right now, the financials would be acting poor. They would acting much, much differently than they are now. They would be lower than they are now. Not saying we can't have a big decline in the financials and it'll take the whole market down with us, but if the market was going to melt away, as a lot of pundits out there would like you to believe, then why wouldn't the financials be leading the way? The answer is simple. They would be under normal conditions, and therefore it's unlikely that the entire market's going to just melt away. I know about all the comments I'm going to get. I'm going to get the comments on the YouTube channel under this video about how bad the economy is and the global this and Europe and all that stuff and China and tariffs. I get all that. It's called the wall of worry. The market always climbs a wall of worry. How many bad headlines were there between 2011, for example, I'm picking a number, and 2018? How many bad headlines did we think were going to cause the market to go down that got ignored? Now, eventually, they'll be more meaningful. I understand that, but there's a bigger picture out there. Now just isn't that time. I understand the dissenting views from that. That's fine. That's what makes a market. Different people look at the same information, the same charts, the same data, and they come out with different conclusions. That's exactly and precisely what make markets. I use my own work, and what my work tells me is now is not that time. The market is not going to just melt away, not yet. The SMH, similar to the same as basically everything else, up about 1.2% today. A good showing, finished near the highs. Again, we need some follow through. It does look like we put in a reversal day here last week. That was in front of the rest of the markets. We discussed it at the time. It's an important development. It looks like the SMH is trying to lead the technology sector out of the doldrums, a higher low. Again, we need more information. We need more follow through. Once the SMH clears 94.06 on daily closes, that'll send it significantly higher. How about a few stocks? How about Amazon? So last week we talked about this low down here with Amazon, and then all of a sudden we had a reversal, a little bit of a pullback, and a nice big update today in Amazon. But think about what happened, and this is the point, right? We didn't know it was going to be a big update today. That's not the point. The point is this. Does Amazon chart look the same or different than the S&P 500? The same or different than the spider? Again, it looks different. In other words, money was flowing into technology before money started rotating into some other areas that made a higher low in the S&P 500. But you can see here that Amazon didn't make the same type of higher low. You'll see that in other stocks as well. So what this was telling you is that it wasn't going to melt away until and unless Amazon was going to take out this low from the 20th, then it was just a pullback, and that reversal was likely going to hold. The market was just testing the lower level. These are all part and parcel to the reasons why I was pounding the table that we buy stocks in these type of situations. Money is made buying stocks in these type of situations. There are a lot of traders out there that try and pick off the index at highs and lows, and they get taken out behind the woodshed. It's much easier to buy stocks. Even if the index goes down, doesn't mean all stocks have to go down. We've shown that over the last few weeks, time and time again. Apple. We have to talk about Apple. Apple had some news after the bell. I didn't catch the whole thing. I caught a snippet. Here's what I think it was. Something about an additional tariff on China phones, something that was going to impact Apple and or its supply chain. Here's the deal. It's not going to make any difference. Look where Apple was. Look where it is now. Another 10% tariff on phones isn't going to make a difference. Apple has already announced about a year ago or more that it was bringing some of the manufacturing back to the U.S. in some kind of partnership with one of its suppliers, manufacturing suppliers. So they're going to be making at least some of, or a lot of, or components of the phones here. I don't profess to know all the details on that, but I don't care. What I do know is that the news about another 10% tariff on phones coming from China or something like that is not important. It's a bunch of nonsense. What is important is Apple was still under pressure. On a day like today, when the market was up big, Apple really did struggle. It did catch a bit in the afternoon and had a little bit of a rally for $1.50 or so, but then it sold off on that news after the close, put in a little bit of a tail candle. You see where my horizontal trend line is. I think they just want to go fill that number. That's a gap. Gaps get filled. We're too close not to fill that gap. We made an attempt today, didn't quite get there. I'm an owner of Apple. I own Apple at higher prices. I own Apple at about 177.5. I'll buy more if they fill the gap. Otherwise, you'll get the bounce back when the entire market has a broad-based rally more than just one day. There's still some sellers lurking out there in Apple, so one way or the other, I think they're going to go get that gap. Just in case, here's a longer-term chart. Here's a weekly chart. Worse than the gap is about 164. If Apple came down to 164, I would likely buy more. However, I would not tolerate a weekly close below this number right here is 161.84. A weekly close below that, I'm no longer interested in Apple. However, I would like to buy more shares as close to risk as I can get. What do I mean by that? Well, when I say as close to risk, So if my stop out was going to be the low of this breakup candle, happens to be 161.84. And we know that markets like to come back and test former breakout and former breakdown areas. When you put those things together, if we had some kind of a washout in Apple and it did come down to the mid 160s, that's what I call close to risk. It's closer to the point in which I would have to say no mas and end my position, sell out my position on a weekly close below the low of that breakup candle. So nearer to risk, I'm willing to buy more shares. Therefore, if I have to stop out, it's likely small and fast. Now that's on that concept if I was first entering the position down there. I'm already in the position, so if I have to stop out of Apple, it's not small and fast. And by the way, that number puts me somewhere in the neighborhood of plus or minus a percent or so of about 10%, which is about what I'm willing to risk on a stock trade, on a swing trade. Sometimes slightly more, but I like to keep it around 10%. How about Facebook? Taking a look over at Facebook, did we reverse finally in Facebook? It's possible. Anybody can certainly trade against the low from last week in Facebook. That low happens to be 126.85, but that's not where I was willing to buy Facebook. I'll show you, I think I've shown you this before. 120 to 117 was the area. That's where I was willing to purchase Facebook. Didn't get there. I'm not involved in Facebook currently. Netflix, not so great today. Not really a good showing for Netflix. Again, could have a reversal candle here, but it really needs to have some follow through, needs to get up off the mat and get rallying here. So there's still some sellers lurking in Netflix. This is the reason why I wanted to show you that volume in the Qs. Not everything inflated today the way you would expect. Google did. Google had a nice day, up almost $17, 1.6%. Remember Google. So Google made not a higher low, but a slightly lower low, getting down to almost below 1,000. I think it was 1,002. The low was 1,002.21. We never did break 1,000, and they took off from there. Here we are at 10.55, almost 10.56. We talked about 1,000 in Google before it got there on the downside. So when Google was on its way down, I said, it looks like they have to spike it through 1,000. I actually put a number on the chart, and you can see it here. 999.49 was the number. I was willing to step up. I actually never got the chance. Alibaba, good showing in Alibaba. So this is starting to rally. It's looking better and better. Now, as long as we stay above the 50-period moving average on daily closes, that's a positive for Alibaba. You'll remember me pounding the table on this one many, many points ago. Remember this one? We talked about this one when we had that super spike up to $39, $40, and now we've come down, and you can see us way, way below that $39 number. We talked about it in detail at the time. Anybody that wants to go review what we talked about at the time can go back to the video from the 14th. But this was a short at the time. I'm no longer in this trade. For me, it was a one-day wonder. It was a short. Took the money off the table the following day on the gap down, and that was the end of it. There should be lower prices coming in UNG eventually. They'll come back to the 20-period moving average right now, about 31.5. And then there's a bunch of gaps here that will eventually get filled. But there's no trade here right now. Just happened to see it out of the corner of my eye. Figured I'd bring it up. And then I'm going to go over to some other commodities, namely gold. And we'll talk about the gold chart. We've discussed gold trying to get up to some higher prices. It's going sideways. We're above the moving averages. We'll likely go higher in gold. Right now, it's just eating time off the clock, building energy for that next move higher. That's what I see for gold. Should work its way slightly higher. Let's get a different perspective. Let's actually go to a longer term chart. So let's just look at it from a common sense standpoint, a visual perspective, right? So we have a down move, we go up, we go back down. Obviously, we had some big ups and downs in the middle there. Here's the point, right? So let's get rid of this. So the point is this. So we go up from here, and then we come back down, all right? So here, we're trying to rally up again. We're now making a series of higher lows, and it takes time, but the market will now want to work its way up into this zone, potentially higher, but want to work its way up into that zone. It'll take time. This is a weekly chart. It could take a few months to get there. The point is the market moves in phases. It moves in bullish phases. It moves in bearish phases. This was essentially a bullish phase. This was a bearish phase. What comes after a bearish phase? A bullish phase. Doesn't have to be the same magnitude of the last bullish phase. Doesn't have to be the same magnitude of the last bearish phase. But after bullish phases come bearish ones. After bearish ones come bullish ones. It happens on intraday charts. It happens on daily charts. It happens on weekly charts. The reason why I want to point that out is because it's all about our approach, how we look at the charts. From what perspective are we looking at the charts? Are we limiting ourselves to what happened over the last hour or 2 hours or day? Or do we take the long view and say, well, the market just had a down phase. Well, it's likely we're going to have an up phase, but the up phase isn't going to be an up phase every single day. There's going to be down days. There's going to be up days. And the thing gets flipped around the other side on its head. When you have big up moves, you're going to have pullbacks along the way. Down moves, you're going to have rallies in the middle of a bear phase or corrective move. That's just the way the market works. So when we pull back the curtain and look at it from that kind of perspective, it makes more sense. All these charts act and react the same way. Doesn't matter, this is a weekly chart, could be a 10-minute chart. I would tell you the same thing. Since we're on the weekly chart, we'll finish up with crude. Look at that, into the hot zone. Crude oil reversed without me. I'm the only one not in that trade. And look where we went from a high of $77.04 to a low, even today, of $50.10 in 2 months. And we talked about it getting up into that hot zone 2 to 3 months, maybe 4 or 5 months before it even got there. What's my excuse for not being in the trade? I have no excuse for not being in the trade. With that, I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.